Hello class, Al Taccone here again with you, your instructor for financial accounting. Hope you had a great last week and are set to embark on yet another chapter in our financial accounting course, Chapter 10 on corporations paid in capital and retained earnings. As you can see here, I'm with the one friend that I made on a recent Disney cruise that I took. So it was just me and Goofy palling around there. It was a great time, and as you can see there, made a great friend, along with my son, who's a lot younger than I am, but I enjoy the characters on the cruise a lot more than he did. Anyway, let's get started on Chapter 10. Chapters 8 and 9, we pretty much focused on assets and liabilities, as you know, in this part of the course. We're focusing on the individual components of the financial statements pretty much, and how we account for the variety of things that can happen to all of those parts of the financial statements. This week it's on the paid in capital and retained earnings section of the balance sheet. So let's get started looking at our objectives, our learning outcomes. There are 8 of them in this chapter. We'll review the characteristics of a corporation, and you should be able to identify those. When you're done studying the chapter, you should be able to describe the 2 sources of stockholders' equity and the different classes of stock. You should be able to journalize the issuance of stock. You should be able to do the accounting for cash dividends. And then the last 4 objectives, you should be able to account for stock dividends and stock splits. You should be able to handle the accounting for treasury stock. You'll be able to prepare the stockholders' equity section of the balance sheet. And then the one ratio that we'll learn in this chapter, we learn 1 or 2 each chapter, as you know, along with a larger last chapter that we cover with a whole bunch of these all put together, and that's the return on stockholders' equity. You should be able to calculate it and evaluate. All right, so let's get started. And again, usually we go in order of the objectives. Let's take a look at what a corporation is. These 6 blocks that you see here on your screen represent the characteristics of a corporation, what comprises the corporation, and then we'll look at advantages and disadvantages next. The articles of incorporation describe the purpose, place, and other details of a corporation. Sometimes this is called the charter or the corporate charter. These have to be filed with the state in order to be approved as a corporation in that state. So it includes, once again, the purpose of the corporation, the place that it will exist, and any other details about the corporation. We're not going to get into the legal aspects in this course because we're studying accounting. But obviously, and as you can imagine, there are a significant amount of legal details that you have to go through to incorporate. Capital stock represents the individual's ownership of the corporation's capital. We've seen that before. We just haven't done the accounting for it yet. A share is the basic unit of stock. A share of stock. We've used that term before as well. Authorized stock is the number of shares of stock a corporation is authorized by the state to sell, the state in which it's incorporated. So as part of the articles of incorporation, you're filing for the number of shares that you want to be able to sell as a corporation. That's authorized shares because the state has approved it. Stock certificates are the certificates that provide evidence of stock ownership. So when the corporation sells shares of stock to individuals in the public, they also get a piece of paper, an actual certificate that says that they own that share or a number of shares. And outstanding stock is the stock in the hands of the stockholder. In other words, you have authorized shares, which is how many shares the corporation is allowed to sell. The outstanding shares of stock are the actual shares that have been sold. Excuse me. All right, there are advantages and disadvantages to the corporate form of ownership. You can see them broken down here on the screen in Exhibit 10-2. The advantages on the left. And one thing I want to remind you as you're perusing these is that the corporations are the dominant business activity in the United States. They're the dominant form of business ownership. Activity. not ownership. Corporations dominate the amount of commerce done in the United States, the number of business done in the United States, but proprietorships and partnerships are way more numerous. In other words, there are more of them, but corporations do much more business, mostly because they're usually larger, so it doesn't take a lot of corporations to actually come together when you take a look at their revenue and activities to actually equal much more than partnerships and proprietorships. Their full names include corporation or incorporated. You've probably seen that before. And that indicates that they are a corporation. Advantages of the corporation include, on the left, stockholders have limited liability because a corporation is a separate legal entity. In other words, if an individual owns a share of stock, that's the most that they are held liable to. In other words, the individual who owns a share of stock, if you paid, let's say, $100 for a share of stock and the corporation goes bankrupt, all you lose is what you paid for that share of stock. The corporation is a separate legal entity. Corporations can raise more money than proprietorships and partnerships, even based upon what we've just seen so far, where corporations have the opportunity to authorize a number of shares of stock based upon what they need to raise in order to function as a business. Proprietorships or partnerships might have way fewer people. Corporations have a continuous life. What that means is that even if a stockholder or holders die or sell their shares, the corporation still exists. In a proprietorship or partnership, when one or more of the owners die or decide they want out, a new business must start. The proprietorship or partnership ceases to function. And finally, the ownership of corporations is easy to transfer. In other words, an individual who owns a share of stock or shares of stock may simply sell those shares, and that piece of the corporation's ownership transfers very simply. Two big disadvantages, though: the government regulation is cumbersome and expensive for corporations, as you've seen historically and we've touched upon briefly in our chapter on ethics in terms of the Sarbanes-Oxley Act. And double taxation, which we'll talk about a little bit later in this chapter. What that basically means is that a corporation's profits are taxed, their income before taxes. However, there's a second tax, and that is in the form of taxes that are paid on dividends paid to stockholders. In other words, a corporation will pay a tax based upon its income before taxes, its taxable income before taxes. Then, when the corporation, if it decides to, actually issues dividends, those dividends in the form of dollars go to stockholders. Those stockholders must claim those dividends on their individual tax returns, thereby taxing it. So there's a double taxation. So there's your advantages and disadvantages. Again, we won't dwell on those, but please know what they are. We're going to be focusing more on the accounting aspects, as I said in this course. All right, let's take a look at what comprises stockholders' equity for a corporation. There are two parts to stockholders' equity. There's paid-in capital and retained earnings. Paid-in capital, which is also could be called contributed capital, represents the amounts received from the stockholders. Common stock is the main source of paid-in capital. This is externally generated capital and results from transactions with outsiders, meaning these are the shares of stock, or represent the shares of stock that have been sold to who are now stockholders. That means somebody gave the corporation money for a share of stock or shares of stock. That's called paid-in capital. It's externally generated. Retained earnings represents capital that has been earned by profitable operations and not paid out as dividends. This is internally generated capital and results from internal corporate decisions and earnings. In other words, when a corporation is profitable, it can do one of two or a combination of things with its profit. It can pay it out in the form of dividends to the shareholders. It can keep it all. The part that they keep is called retained earnings, or they could do a little bit of both. The corporation could pay out part of its profits in the form of dividends and keep part of it in the form of retained earnings, or do just one or the other. So the part that the corporation keeps out of its profits is retained earnings. And once again, just to reiterate, paid-in capital, which is externally generated, is what is generated by investment. Individuals purchasing shares of stock in our corporation. And hopefully that makes sense, and those are the two parts of stockholders' equity. Now, if you own a share of stock, or the individuals who own shares of stock in a corporation, they have four basic rights. They have the right to vote, they have the right to dividends, they have rights when it comes to liquidation, and what we call preemption rights. Let's look at them one at a time. First, as far as voting rights, stockholders participate in management of the corporation by voting on corporate matters. This is the only way in which stockholders can help manage the corporation. Normally, each share of common stock carries one vote. Remember, you own shares of stock in the corporation, but you don't have direct managerial decision making in terms of operations. The way that you manage the corporation is by voting. Dividends relates to situations and the fact that stockholders receive a proportionate part of any dividend. Each share of stock receives an equal dividend. So, for example, a shareholder who owns 1% of the total shares in the company receives a 1% of any dividend. And we'll be taking a look later on how dividends actually come about, how they're declared and paid. But it's paid proportionately, based upon the percent of shares that the stockholder owns. Stockholders receive their proportionate share of any assets remaining after the corporation pays its debts and liquidates. In other words, it goes out of business. Those are called liquidation rights. That means if the corporation goes out of business and it's liquidating, all of its debts will be paid, or a percentage at least of those debts based upon bankruptcy court if it gets that far. But the stockholders do have a right to whatever's left. Chances are there isn't going to be much in most liquidations, but in the case that there is, the stockholders will get what's left after the debts are paid. All right, preemption relates to stockholders maintaining their proportionate ownership in the corporation, meaning if you currently own a certain percentage of the shares of stock, you have the right to maintain that percent. So suppose you own 10% of a corporation's stock. If the corporation issues 250,000 new shares of stock, it must offer you the opportunity to buy 10% or 25,000 of those shares. Most states require the preemptive rights be specifically set forth in the corporate charter. For most companies, preemptive rights are the exception rather than the rule. So remember, you can maintain your proportionate ownership of the corporation by the corporation allowing you to buy additional shares if new shares are being issued so that you maintain your percentage. All right, so those are the four stockholders' rights. Now let's break things down a little bit further and take a look at stocks. There are two classes of stock and three values. Common stock is the most typical kind of stock. It usually has voting rights, the rights to receive dividends, and the right to receive assets if the company liquidates. Excuse me, I just coughed and hit the microphone at the same time. Preferred stock is a stock that gives its owners certain advantages over common stockholders, such as the right to receive dividends before common stockholders and the right to receive assets before the common stockholders if the corporation liquidates. That's why it's called preferred. All right, let's take a look at values. Par value is the arbitrary amount assigned to a share of stock. So when the corporation sells shares of stock, it's going to give those shares a par value per share. Stated value is also an arbitrary amount that is similar to no par value, but is assigned after a corporation is organized. So if the corporation issues shares of stock that don't have a par value, it will assign a stated value after the corporation is organized. It is also possible for a company to issue stock that has no par or stated value, and that's called no par stock. So par value is stated when the corporation sells the shares of stock. It's actually the par value. Stated value is a value that's placed on the shares of stock after the corporation is organized, and no par value means there is no par or stated value. So keep those in mind along with the classes as we go through our examples related to issuing and selling shares of stock. And we're going to look at those one at a time, starting with issuing common stock at par value. So in the example on your screen, we have Tricor Industrial Coatings. It's a corporation, obviously. Their common stock has a par value of $5 per share. If we issued 10,000 shares of stock at par value on January 1, but the selling price was of those 10,000 shares was $5 par, that gives you $50,000 because we sold them at par. So we sold the 10,000 shares at their par value. The par value is $5. 10,000 shares, we multiply, that's $50,000. So since the corporation got cash, we debit cash for $50,000 and we credit common stock. Remember, that's an equity account. Common stock is a capital account or equity account. It's being increased, so that requires a credit. It's just like investing, if you remember, for a proprietorship where you debited cash and credited capital. Difference here is you're exchanging shares of stock. It's still the same concept, though. It's still equity. It's still capital. All right, so that's issuing common stock at par. But let's say we issue the common stock at above par. And you might say, well, why do we do that? Well, if people are willing to pay more per share of our stock, of course we're going to sell it for more. And why might that be? Well, it's because our corporation is doing very well. People want our shares of stock, so the demand for our shares are up and the supply is what it is. It's limited. So we're going to take advantage of that and we sell the shares above par. So in this example, we're going to assume the 10,000 shares are sold or issued for $20 a share. Okay, that's $15 per share above the par. So this time we got $200,000. We debit cash for $200,000. That's 10,000 shares at $20 a share. We still credit common stock, though, always for the par value. So we credit common stock for the $50,000, 10,000 shares at $5 par. But we have to make up that difference of $150,000. That's an additional credit called paid in capital in excess of par dash common to represent the fact that this paid in capital in excess of par related to the common stock. Now, how do we get that? Well, we just mentioned it. We sold at $15 above par, or $20 minus the $5 par, times 10,000 is $150,000. Or you could also look at it, we sold those 10,000 shares for $200,000. The common stock at par is $50,000, so obviously the paid in capital in excess of par has to be $150,000. On the balance sheet, you might also see that represented as something called additional paid in capital. Because remember, this is all generated externally. People are paying me, or our corporation, not me, the corporation, for shares of stock. In this particular case, it was in excess of par, so it's still accounted for as capital. Okay, hopefully that makes sense. All right, let's take a look at issuing no par stock. So this time, assume that instead of a $5 par value, Tricor Industrial Coatings common stock was no par. The entry to record the issuance of the 10,000 shares of no par stock for $20 a share would be just very simply a debit to cash for $200,000 and a credit to common stock for $200,000. Reason why: this was no par stock. We don't have anything to compare the $200,000 to. All right, so that's no par stock. There's no need to have an additional paid in capital because there was no par to compare to. All right, I hope that makes sense to you. Now, if you had stated value would act very much like par value. So So if we just go back to the issuing the stock above par, if it was a $5 stated value we were comparing to as opposed to par value, this transaction would be very, very similar, except it would be paid in excess of stated value. All right, so that's issuing no par stock. Now let's say you issue stock for assets other than cash, which, as you know, can happen. Investments take place and we might get assets other than cash. So let's say this time, instead of cash, Tricor Industrial Coatings received a building that has a fair market value of $200,000 in exchange for those 10,000 shares of its $5 par common stock. Well, the building has a fair market value of $200,000, so we have to debit building for $200,000. We still have to credit common stock for its par value. $5 a share times 10,000 shares is $50,000. And as you can see, we have additional paid-in capital in this case, or paid-in capital in excess of par, common, which is the actual account name, of $150,000. So much like what you would be doing had that $200,000 been in cash, as we saw earlier, except this time you're debiting for the fair market value of the building. Remember, we can always have investments for assets other than cash. Doesn't have to be cash. But in this particular case, when you're looking at the capital investment, the fair market value was above the par, so we still have to account for the paid-in capital in excess of par. So those are your transactions for common stock. Now we're going to take a look at the transactions related to preferred stock. So let's take a look at issuing preferred stock. This time, let's assume that Tricor Industrial Coatings decides to issue 5,000 shares of its $15 par, 10% preferred stock on February 15th for $25 a share. Now, first of all, what that means is, yes, they are issuing 5,000 shares of stock for $25 a share. What 10% refers to, 10% preferred stock means, is that's a return on investment for the stockholder. In other words, what we're saying is where you are going to get a 10% return on your investment before the common shareholders get any portion of the dividends. And when we see return on investment, what we're talking about eventually is these stockholders getting dividends. So let's see how that works. We debit cash for 5,000 shares at $25 a share. That's $125,000. We still credit for the par value, so we credit preferred stock. 5,000 shares times the $15 par value is $75,000. And then the difference is the paid-in capital in excess of par, this time preferred, because it's preferred stock, for $50,000. And again, you find that simply by the difference here between how much cash we received and the par value. Or you could also look at it, excuse me, that the par value is $15 a share. We actually sold it for $25 a share. That's a $10 difference above par, and $10 times 5,000 shares is also $50,000. So very, very similar to issuing the common stock. All right, so it's very, very similar. We'll talk about the dividends next because that relates to the 10% preferred. So I'm not going to go through the series of transactions for at par. In this case, you got it above par, and the at par would be the same as the common stock transactions. All right, now when individuals buy shares of stock, there is an expectation that they are going to receive dividends. And there are different types of dividends. We're going to start by looking at cash dividends. There are various components that relate to legal aspects of equity. And legal capital is the portion of the stockholder's equity that cannot be used for dividends. A corporation declares a dividend before paying it, so that's step one. There are 3 dates associated with the declaration and payment of cash dividends, and these 3 dates are very important as we move forward. Number one, as I said, step one is the declaration date. On the declaration date, the board of directors announces the intention to pay the dividend. The declaration of cash dividend creates an obligation for the corporation, and we know by now an obligation for our corporations is a liability. It is for any business. Any obligation is a liability. So they might pick a date. Let's say March 5th, just to pick a date, is the declaration date. So keep that in mind, March 5th. The date of record, it relates to those stockholders holding the stock at the end of business on the date of record, usually a week or two after the declaration date. Let's just pick a date, March 19th. Those people, those stockholders will receive dividends. So the date of record means you have to have owned shares of stock by the date of record in order to be eligible for the dividend. So what we're pretending here, or using as an example, let's say the cash dividend was declared on March 5th. The date of record is March 19th. The payment date is when the payment of the dividend occurs. It usually follows the record date by a week or two. Let's just say by the end of March, March 31st. So the board of directors declares the dividend on March 5th, let's say. The date of record we said was March 19th. In other words, everyone who owns the shares of stock by March 19th is eligible for the cash dividend. And we have said the payment date will be the last day of March, March 31st. So I hope conceptually that makes sense to you, the difference between the declaration date, the date of record, and the payment date, 3 critical dates related to dividends. All right, let's take a look at declaring and paying the dividends for preferred stock versus common stock. The annual dividend rate on preferred stock is often expressed as a percentage of the preferred stock's par value, like we saw when we took a look at issuing preferred stock. It was 10% preferred stock, for example. What that means is that they'll get a 10% return. But sometimes annual cash dividends on preferred stock are expressed as a flat dollar amount per share, such as, $1 a share or $1.50 a share. So it can be based on a percentage return or flat dollar amount. So it might be, $50 par, $2 preferred stock. That means there's a $2 per share dividend. 10% means you'll get a 10% return on what was paid for the shares. Excuse me, the par value of the shares, not what was paid. I'm corrected there. It's the par value. The percentage is based on par value. So that's preferred stock. Cash dividends on common stock are computed as a flat dollar amount because those cash dividends are not expressed as a percentage. And that's usually why preferred stock costs more when you buy it, because you have those guaranteed returns on your investment. Common stock will be a flat dollar amount that's declared by the board of trustees. Of course, it'll still have, as we saw in the previous slide, it'll still have a date of record and a payment date. It's just that the board of trustees are going to declare that amount, a flat dollar amount, which will be divided up amongst the common stock shares that are outstanding. All right, so let's walk through an example. I know this slide looks busy, so hang in there with me. That relates to declaring and paying dividends. So here we have Tricor Industrial Coatings. They have 5,000 outstanding shares of 10% $15 par preferred stock. Question 1, what are the preferred dividends per year? Well, we multiply the 5,000 outstanding shares times the $15 par value times 10%. That means the preferred dividend annually is $7,500. But let's say instead, so that's one way of doing it. Let's say instead, though, of a 10% dividend, Tricor Industrial Coatings' flat rate dividend was stated at $1.50 per share. If that was the case, the preferred dividends would be calculated like you see here at the bottom of the screen. It would be the 5,000 shares just multiplied by the flat dividend rate of $1.50, giving you the same $7,500. So you can see it can be expressed either way, the key here is how you calculate it, because we happen to use the same example here. Number of shares could change every year, etc. But here, 5,000 shares at $15 par at 10% return is 7,500. If it was $1.50 flat rate per share, it's the 5,000 shares. Each share gets $1.50, so you multiply that, and there's your $7,500 preferred dividend. All right, let's continue along with the how to record the journal entries for the declaration of a cash dividend. Right, so we have the $7,500. We know that, right? So we have to debit. Remember, we said the date was March 5th. We debit retained earnings or dividends for $7,500 and credit dividends payable for $7,500. Now the dividends account, notice it can be either one, dividends or retained earnings, so let's talk about that for a minute. The dividends account is closed to retained earnings at the end of the year, much like withdrawals is for a proprietorship. So instead of using the dividends account, companies can record the declaration of a dividend by directly debiting the retained earnings account instead of dividends. Remember, because if dividends ends up closing to retained earnings, it will end up reducing retained earnings anyway, like withdrawals does to capital. So this is also acceptable, debiting retained earnings, or you could debit the separate account dividends. You just have to remember that account gets closed at the end of the period. We credit dividends payable because we're not paying the dividends on this date. Remember, that's the date of declaration. So on the date of declaration, we owe the $7,500. There is no journal transaction required of the date of record. Remember, the date of record, which we said was March 19th, is just that. All that is the board telling us the cutoff date for actually owning shares of stock to be eligible to get the cash dividends. So let's see what happens then on the payment date. That's the day we actually pay the dividends. You will debit the liability, dividends payable, because you don't owe it anymore, and of course credit cash for $7,500. So that finishes up declaring and paying dividends with the paying part. All right, now let's take a look at what happens when we have preferred and common shareholders and what happens with dividing up the dividends. So let's assume that Tricor Industrial Coatings has 100,000 shares of $5 par common stock outstanding and 5,000 shares of $15 par 10% preferred stock outstanding during 2016. Earlier we calculated that amount to be $7,500. We've seen that a couple times now. So total declared dividends must exceed $7,500 for common stockholders to get anything. So remember, if the board of directors declares a dividend, the preferred stockholders must get all of their $7,500 before the common stockholders get anything. That's why it's called preferred stock. They have preferential treatment. All right, so keep that in mind. The preferred stockholders must get paid their 10% before the common shareholders get anything. That's the reason why it's called preferred stock. All right, so let's take a look at what that would look like. Two different situations, situation A, situation B. If the board of directors declares a $5,000 dividend, the preferred dividend would be all $5,000 because remember, they actually are owed $7,500. So the preferred stockholders will get $5,000. The common dividend will be zero. Remember what we just said. In order for the common stockholders to get anything, the board would have had to declare more than $7,500. As you can see here, the preferred shareholders are not even getting their $7,500. They're only getting the $5,000 the board declared. But in the second situation, where the board declares a $20,000 dividend, The preferred dividend will be, as we already saw, the 5,000 shares times $15 par times 10%. There's your $7,500 that we've been using right along. But since there's 20,000 available that the board declared, the common dividend will be that 20,000 minus the $7,500 that goes to the preferred shareholders, meaning there's $12,500 left for a common dividend, totaling, of course, $20,000. So the preferred shareholders will get their $7,500 in situation B, and the common dividend will be the difference, the remaining $12,500. That makes up the total dividend declared of $20,000. Does that make sense? Now, let's not forget this situation here. The preferred shareholders in situation A did not get their $5,000. We're going to see how that plays into the type of preferred stock dividends based upon the shares when they're sold. And that's the difference between cumulative and non-cumulative preferred stock. Most preferred stock, right up front here, is cumulative, just to get that out of the way. Most of the preferred stock sold is cumulative. If there is nothing stated, if the preferred stock doesn't have or state on it whether it's cumulative or non-cumulative, it's assumed to be cumulative. So even if it doesn't state the type of stock, preferred stock, it is assumed to be cumulative if nothing stated. Dividends in arrears represent unpaid dividends from prior years on cumulative preferred stock. For example, in the previous example we looked at, the dividend was $5,000 in situation A to the preferred shareholders. Should have been $7,500, but we didn't declare enough. The corporation didn't declare enough. So that means there's $2,500. If this were cumulative preferred stock, the preferred stockholders are still owed $2,500. That's called a dividend in arrears. Cumulative preferred stock is preferred stock whose owners must receive all dividends in arrears plus the current year dividend before the corporation pays dividends to the common shareholders. So keep that in mind. In our previous example, for example, the preferred shareholders must get their $2,500 difference from that year plus any dividends declared in the current year before the common shareholders get any dividend. Okay, hopefully that makes sense. Think about it. And again, the PDF of the PowerPoint slides is always available to you to print or take a look at separately. And thankfully, so are my videos, which you can watch over and over and over again. All right, let's take a look at allocating dividends, cumulative dividends. So let's suppose Tricor Industrial Coatings, passed the entire 2015 preferred dividend of $7,500. In 2016, Tricor declared a $50,000 dividend. So let's see how that works. All right, there's a total dividend declared in the current year of $50,000. The 2015 dividend was the $7,500, but they passed. They didn't pay out any of it. So the preferred shareholders are owed the 2015 dividend plus the 2016 dividend. Same calculation, 5,000 shares, $15 par at 10%. So the total that will go to the preferred shareholders in 2016 is $15,000. The $7,500 they were owed from 2015 plus the additional $7,500 that they are owed in 2016. I'll leave that up there for a second. Now, what does that mean for the common shareholders? Well, good news for them, because the preferred shareholders are going to get $15,000. That leaves $35,000 for the common shareholders, the difference between the $50,000 declared and the $15,000 that we have to pay out here in 2016 to the preferred shareholders. So you see how that works? We have to pay any dividends in arrears plus current year before we pay anything to the common shareholders. All right, let's see how that looks in terms of journalizing. Let's say Tricor Industrial declared the $50,000 dividend on November 10th of 2016. Well, we know that's an important date because that's the date of declaration, November 10th. We have to debit retained earnings or dividends, depending upon which you choose. I mean, when you're using your textbook example, you'll be told, there's your $50,000. We credit the dividends payable for $15,000, as we just saw, to the preferred, and another credit to dividends payable common for the $35,000. And again, those numbers are coming from the previous calculation we just saw. $15,000 to preferred, $35,000 to common. And what you have here is the resulting journal entry on the date of declaration. Okay, and obviously these two are liabilities, so they carry into the new period. And if you debited retained earnings here, there is no closing of dividends. Again, retained earnings is a permanent account, so that balance always carries over from period to period as well. All right, let's take a look at allocating non-cumulative dividends. Suppose Tricor passed the entire 2015 preferred dividend of $7,500. So that example, that part of the example we're leaving the same. But now the preferred stock, rather than cumulative, is non-cumulative. In 2016, Tricor declared a $50,000 dividend. So the total dividend is $50,000. It's non-cumulative. So the only dividend due is for the current year, 2016. That same $7,500, we just didn't redo the math here. That means the total to the preferred shareholders will be just that $7,500, leaving even more. For the common shareholders, they'll get the remaining $42,500. So you see the difference between this example and the last one. Non-cumulative means it doesn't really matter what happened in 2015. Yes, had a dividend been declared, they would have gotten up to $75,000, but nothing was declared. It was passed. So this year, the board of directors declared a $50,000 dividend, so they're going to get $7,500 out of that before the common shareholders get the remaining $42,500. All right, so let's see how that looks in a journal entry. Once again, we'll still debit retained earnings or dividends for $50,000. We credit dividends payable preferred, $7,500. And did I say debit? I meant credit if I said that. Credit dividends payable for preferred, obviously, and also credit dividends payable common. I keep wanting to say debit for some reason. So it's a debit to retained earnings or dividends, $50,000, credit dividends payable preferred for that $7,500, and another credit to dividends payable common for the $42,500 that they get of the remainder. And that's on November 10th because that's the declaration date. Of course, we already did transaction. What happens on the payment date? Of course, you would debit these two liabilities and credit cash on the payment date. Okay. Now there are other types of dividends. Actually there's only one other one. It's called stock dividends. I lied, there's not many. There's only two: cash dividends and stock dividends. A stock dividend is a distribution of a corporation's own stock to its stockholders. Unlike cash dividends, with stock dividends, a company is not required to give any of its assets to the stockholders. In other words, no money, no cash, no other assets. Stock dividends affect only stockholders' equity accounts, including retained earnings and common stock. They have no effect on stockholders' equity, and they have no effect on assets or liabilities. A corporation distributes stock dividends to stockholders in proportion to the number of shares of stock they already own. So let's suppose you own 500 shares of Tricor common stock. If Tricor distributes a 10% stock dividend, you would receive 50 additional shares. 500 shares times 10%. That means you would now own 550 shares of the stock. All other Tricor stockholders also receive additional shares equal to 10% of the amount of stock they currently hold. Remember that preemptive right? Well, that comes into play here. If you're getting an equal amount of shares as everybody else, everyone gets increased by the same percent. In other words, everybody stays with the same percentage of ownership. Because the amount of stock every stockholder has increases by 10%, as I said, the stockholders would all own the same percentage share of Tricor Coatings stock as they did before the stock dividend. That's that preemptive right again. All right, so basically what a stock dividend means is we declare a stock dividend, meaning we're giving a percentage of what stockholders already own to them in additional shares. And you're probably asking yourself, why would we issue stock dividends? Well, there's 3 reasons. 1, to continue a history of declaring dividends while conserving cash. Remember, when you pay a cash dividend, you're expending cash, which means you don't have that cash available for other types of business-related activities that may be more crucial to the business growing. Second, to reduce the market price of its stock. Remember supply and demand. If you issue more shares of stock, that increases the supply. If you increase the supply and the demand stays the same or is lower, that's going to reduce the market price of the stock because supply exceeds demand. And the third would be simply to reward your investors. Investors often feel like they've received something of value when they get a stock dividend. So they do get a dividend, but it's just not in the form of cash, meaning you preserve your cash flow. So those are 3 reasons for declaring and paying stock dividends. And once again, the reason why people want to invest in a corporation is twofold. 1, so the value of the share of stock goes up. The other is because you receive dividends. All right, let's take a look and see how we go about recording stock dividends. Once again, there are 3 dates associated with a stock dividend: the declaration date, the date of record, and the distribution date. Once again, this is all related to the board of directors. They will announce the stock dividend on the declaration date. The date of record, once again, determines who will receive the additional shares. So in other words, you have to own shares as of that date to be eligible. And the distribution date, of course, is the date the additional shares are distributed to the stockholders. Unlike with a cash dividend, the declaration of a stock dividend does not create a liability. So keep that in mind. We don't owe anybody anything because it's not an asset being distributed. With a stock dividend, the corporation has simply declared its intention to distribute more shares of stock. Once again, you don't owe anything to anybody as a result of a stock dividend being declared. All you're doing is saying, as a corporation, and the board of directors is saying, we intend to give people more shares. We don't owe them an asset. So what are the affected accounts when we issue a stock dividend or from declaration through issuance? Retained earnings, paid in capital in excess of par, and common stock. Retained earnings is reduced, or remember, if you're using the dividends account, dividends would be increased. Both would require a debit, of course, because you're reducing them either way. So those debits would include an amount equal to the number of shares being distributed times the current market price per share of the company's stock. So you're reducing retained earnings or debiting dividends, which is actually an increase, has the same effect, doesn't matter, they're both debits, same effect on retained earnings. It'll be the number of shares times the market value. Common stock will be increased with a credit by an amount equal to the number of shares being distributed times the par value of the share of the company's stock. So the retained earnings is debited, or dividends debited, for the market value of those shares. Common stock is increased with a credit for the par value, and just like we saw with with the sale of stocks, paid in capital in excess of par will be increased as a result of the difference between the par value, the par value down here, and the market value. Again, always the difference between market value and par value is paid in capital in excess. Now let's take a look at how that all impacts the stockholders' equity section of the balance sheet. So let's do a before and after. So before the stock dividend, here's the stockholders' equity section of Tricor's balance sheet. There's the preferred stock at par, current paid in capital in excess of par for preferred, $50,000. There's your common stock at $500,000, paid in capital in excess of par common, $1.25 million. $1.875 million is the total paid in capital when you add that together. The corporation's retained earnings are $750,000, meaning the total stockholders' equity is $2.625 million. So that is the current Tricor stockholders' equity section of its balance sheet. Now we're going to go through the transaction that gets recorded in the journal, and then we'll see the after stockholders' equity section once the posting takes place. So here's the example. If Tricor declared and distributes a 10% common stock dividend on June 15th, when the market value of the common stock is $40 a share. So the dividend is 100,000 shares times 10% times $40, because again, we're talking about a 10% dividend. Okay, the market value is currently 40. So the debit is that $400,000, debit retained earnings or dividends. Then we credit common stock for the par value. Remember, the par value of the stock is $5. So it's 100,000 times that 10% stock dividend times the $5 par is 50,000. So the paid in capital in excess of par common has to be the difference, which is the $350,000. So you see how that works? So the accounts you're going to see affected when we look at the after stockholders' equity section are the accounts that you see here. Okay, so let's take a look at the after. You can see the preferred stock is now, or still, $75,000. The paid in capital in excess of par, it would be all after posting of the transactions you just saw, is $50,000. The common stock is $5 par times the 5,000 shares authorized but 110,000 shares outstanding, $550,000. The paid in capital in excess of par is now $1.6 million. The total paid in capital, $2.275 million. Add to that the retained earnings of $350,000. You still have total stockholders' equity of the same amount, $2.625 million. The total stockholders' equity does not change when you declare and end up issuing stock dividends. So let's go back 2 slides and you can see that. We increased the number of shares of common by 10,000 to 110,000 shares. The paid in capital in excess of par changed. However, let's go 2 slides forward again. The retained earnings reduced to $350,000. Once again, because the difference went into the additional shares of stock and the additional paid-in capital in excess of par. But in the end, the total stockholders' equity can't change, because really all you've done is taken some of your retained earnings and put it into the common stock accounts, both the common stock account and the paid-in capital in excess of par common account. So kind of go back and forth between those two using the journal entry in between. We're not going to focus on posting here. All this is assumed that you posted that transaction correctly. The point of the matter here is to realize that your total stockholders' equity does not change when you issue a stock dividend. All right, let's take a look at a special situation known as a stock split. Both a stock dividend and a stock split will increase the number of shares of stock issued and outstanding. We just saw that with the stock dividend. We know the number of shares issued is going to increase and the number of shares outstanding increases. However, a stock split is fundamentally different from a stock dividend. A stock split decreases the par value. That did not happen with a stock dividend. A stock split decreases the par value per share, whereas stock dividends do not affect the par value per share, as we just saw. In addition, in the case of a stock split, no journal entry is required. No journal entry is required. So for example, if we're just to throw a number off the top of my head here, if you do a 50% stock split, what that means is that you're going to double the number of shares outstanding, but you will cut the par value in half. So you'll have more shares outstanding, but the par value will be less. So it decreases the value per share, and this is par or stated value. Decreases the market price of the share because you're going to have a whole lot more shares out there in the open market, which increases the supply, and all other things being equal will reduce the market value. So obviously when that happens, it has to be, the total stockholders' equity always stays the same. So you have more shares at less par or stated value. Okay, hopefully that makes sense to you. I know I say that a lot. That's kind of my catchphrase. Hopefully. But let's see how the stock split works using a side-by-side comparison of Tricor's before and after a stock split. So let's look at the stock. All right, so we still have, if you look at the preferred stock, 10%, $15 par. That didn't change. However, we had a stock split for the common stock. The common stock, which had a $5 par, 500,000 shares, what's going to happen is, instead of having 110,000 shares issued, now there's a stock split. So the number of shares issued doubles to 220,000, but the par value decreases by a half, 50%, to $2.50. So the total common stock is still 550,000. That's why there's no journal entry required. This is merely indicated on the balance sheet stockholders equity section. So you see that a stock split in half. We double the shares, 110 to 220, but the par gets cut from 5 to 250. So just an inverse relationship. Double the shares and then cut the par or stated value in half. Nothing else changes. Notice the dollar amounts all the way down for both the before and after are exactly the same. The only thing impacted are the number of shares and the par or stated value. So no journal entry required for stock splits. Okay? All right, let's take a look at cash dividends, stock dividends, and stock splits, kind of a comparison. Stock dividends and stock splits have some similarities and some differences, as we just saw. Here on your screen, you have a representation of the effect of cash dividends, and stock splits on the stockholders' equity accounts. Just to give you an idea, if you want a little cheat sheet to know what the differences are and how they impact those components of stockholders' equity. Stock dividends increase common stock and paid in capital in excess of par, and decrease retained earnings. Stock splits have no effect on common stock, paid in capital in excess of par, retained earnings, and total stockholders' equity, as we just saw when we looked at the example on stock splits. You are just merely indicating in the stockholders' equity section that there's an increase in the number of shares and a decrease to the par or stated value. So this slide just gives you a little comparison using words. What happens to those components of stockholders' equity in each case. All right, another possibility when we relate to buying and selling stocks is treasury stock. Treasury stock is a corporation's own stock that it has issued and later reacquired. In other words, we already sold shares, in other words, they're outstanding, and we buy them back. Now you might be saying, why would we do that? Well, there are 4 reasons why you might acquire treasury stock, meaning you're going to buy your own shares of stock that have already been issued. 1, management hopes to buy the stock when the price is low and then sell it when the price goes high, just like any other reason people buy shares of stock. You want to buy it at the low and sell at the high, just like buying real estate or anything else, or any investment. Management may want to support the company's stock price. In other words, by buying back shares of stock, it takes shares out of circulation, which decreases supply, and all other things being equal, if the demand is still there, but you take shares of stock out of circulation because you now own them back again, that's going to reduce the demand, which would increase the market value. Management may want to avoid a takeover by an outside party. If the company purchases the available shares, the shares are not available for others to purchase. You might see a takeover out there, somebody or some other company who's wanting to buy a lot or a vast majority of your shares of stock so that they have a takeover, meaning they have majority ownership. So you might want to buy those shares back. Or management may want to reward valued employees with stock. Treasury stock can be given to employees as a reward. So you might buy back some of your own shares of stock from the market. That's called treasury stock. You can give that to your employees as a reward for doing a good job. Treasury stock transactions are common among larger corporations. Smaller corporations aren't going to mess around with treasury stock, but larger corporations that have, thousands and thousands or millions of shares, quite possibly would it be involved in treasury stock transactions. Here are some basic concepts related to treasury stock. The treasury stock account is a contra equity account. Therefore, treasury stock has a debit balance. Remember, all your equity accounts have credit balances. And that's the opposite of your other equity accounts. Treasury stock is recorded at cost. You ignore par value with treasury stock. You record it at what it cost you. And the treasury stock account is reported beneath retained earnings on the balance sheet as a reduction to the total stockholders' equity. And that should make sense, because if you're buying back your own shares of stock that were in the marketplace, that should have the impact of reducing your stockholders' equity. So your outstanding stock becomes your shares issued minus your treasury stock. And outstanding shares are important because only outstanding shares have voting rights and received dividends. Remember, the treasury stock does not, because actually the corporation owns them. Only outstanding shares have voting rights. All right, let's walk through an example for the purchase of treasury stock. Tricor, here's their stockholders' equity section of the balance sheet after the stock split that we looked at earlier. So there's the same exact after the stock split section, stockholders' equity section of Tricor's balance sheet. So that's what we're working with. Let's say we're going to purchase some treasury stock now based upon what you see here on your screen. So assume that on August 10th, Tricor purchased 1,000 shares of the company's issued common stock, paying $25 per share. Remember, treasury stock is recorded for what you paid for it in cash, so we debit treasury stock for $2,500, 1,000 shares times $25, and we credit cash for $25,000. And again, we're doing journal entries, so you can see the explanation there. We've long since not bothered with those in our studies, but that's the explanation. All right, now what happens if we go ahead and sell shares of this treasury stock? Remember, one of the reasons why you might buy treasury stock is you bought it for $25. You might want to sell it for more than $25, or unfortunately, you might sell it for exactly $25. So let's see what happens if you do sell the treasury stock, but you sell it at cost. You couldn't make a profit here. We debit cash for 100 shares at $25 a share, which is $2,500, and we credit treasury stock for the same $2,500. Yeah, we only sold 100 of the shares. We originally bought 1,000 of the shares. So for whatever the reason, we're selling those shares at this point. Okay, that's at cost. Hopefully this next situation is really what happens, and that is we sell the treasury stock at above cost. The difference between what we sold the treasury stock for and its cost is called paid-in capital treasury stock, and that will be credited. So let's say in this case, Tricor sold 250 of its treasury shares for $28 a share. So that's $3 more per share than we paid for it on October 2nd. Remember, we debit cash for how much cash is involved. 250 shares at $28 per share is $7,000. We always record anything to do with treasury stock at cost. So the treasury stock is the 200 credit is 250 shares at what we paid for it, $25 a share. That's $6,250. The difference is paid in capital treasury stock for $750. Difference between the cash and the cost of the treasury stock, or you could also look at it, as I said earlier, you actually sold it for $3 more per share than you paid for it. So it's the 250 shares times that $3 more, which is $750. All right, so that's what happens when we sell treasury stock at above cost. And of course, we could also might have to sell it at below cost. So let's see what happens in that case. This time, we sold the treasury stock for $22 a share, 100 shares. So 100 shares times $22 a share is $2,200, so we debit cash. This time, we debit paid-in capital treasury stock for $300 to reduce the balance of paid-in capital treasury stock by the amount that we sold the treasury stock below cost. And then, of course, we credit treasury stock, as always, for its cost. 100 shares at $25 a share is $2,500. Reason why we do that is we might be saying, well, we need to raise a little bit of cash or a lot of cash. One of the things I can sell to do that is to sell some treasury stock. You might be noticing some market fluctuations where you know that buying and selling treasury stock may impact. And so you go ahead and sell the treasury stock for those reasons as well. All right, so that's selling the treasury stock at below cost. Now let's see what happens if it's below cost by another amount. So this time we sell the shares for $20 a share, even lower than the $22 a share on the previous example. What we need to do in that case is use the remaining balance in paid-in capital treasury stock and then take the the remaining difference out of retained earnings. Things have gotten so bad. So we debit cash for $4,000. That's 200 shares at $20 a share, what we're getting. Paid in capital treasury stock, we need to debit for $450. But we have to debit retained earnings for that additional $550 because we had to credit treasury stock for cost of $5,000. Or 200 times $25. Now, Tricor sold those shares of stock on November 1. The company went ahead and we did the debits and credits. The resale price of the treasury stock is less than the $25, so that difference, as you can see here, is debited to paid in capital treasury stock and retained earnings. The remaining balance in paid in capital treasury stock is $450. The shortfall that remains has to go to retained earnings. You have to take care of the shortfall, and you don't have anything left in paid in capital treasury stock to take care of it. So after all of those transactions are posted, here's what your revised stockholders' equity section would look like. You still have 350 shares left in treasury. So you can see here, those 350 shares at cost of $25 is $87.50. So that, once again, as we mentioned earlier, gets deducted from the stockholders' equity section of the balance sheet to get your stockholders' equity. So after retained earnings is added to all of your total paid in capital, you then subtract the cost of your treasury stocks. It's always at cost. And that's going to give you the stockholders' equity. As you can see, it is less this time, of $2,615,700 because treasury stock does affect stockholders' equity, unlike stock dividends and unlike stock splits. All right, so that wraps up our transactions and related impact on the stockholders' equity section of a balance sheet, which leaves us with just to wrap up with that one ratio that's introduced here in Chapter 10, the return on equity ratio, which is calculated by taking net income divided by average stockholders' equity. So we take net income, and as you know by now when you're getting the average anything, you take the beginning balance plus the ending balance and divide by 2. So if a company had $243,000 beginning stockholders, had net income of $243,000, and their beginning stockholders' equity was $1.25 million, and ending stockholders' equity was $1.325 million, your return on equity is the $243,000 net income divided by beginning plus ending stockholders' equity divided by 2, giving you a return on equity of 18.87%. Again, whether or not that's meaningful or not really depends upon the return on equity that other corporations are experiencing. Because some individuals who are many who buy or are looking to buy shares of stock, they're looking for a return. And one of the returns is measured by return on equity. Another one is return on investment, which is something else that we'll study later a little bit, but more so in managerial accounting. But this is the calculation for return on equity. Just keep in mind that that 18.87% is only meaningful, as is true with all of the ratios that we have studied, if you have something to compare to. The past, your competition, industry average, or even trends. All right, well, that wraps up Chapter 10 on paid in capital and retained earnings. So a big smiley happy thumbs up to you for getting through your lecture on Chapter 10. Now it's up to you to move on and complete your Chapter 10 requirements. As always, remember, Besides this video, the PowerPoints are available in PDF format to you as well. So hopefully that works for you as well as you are studying and mastering the material here in Chapter 10. Have a great week. Best wishes as you complete your Chapter 10 requirements, and we'll be back again together for Chapter 11.